Now that we've talked about risk, let's talk about insurance. An insurance policy is a way to transfer your risk of loss to someone else. In this case, it would be the insurance company, because you prefer to avoid risk or prevent risk or mitigate risk, and an insurance company will assume risk. So with insurance, there's this process called underwriting, where the insurance company decides whom they're going to insure and at what rate. And so the greater the risk, the higher the rate. So the company has to guard against adverse selection, meaning taking in a bunch of people who are really risky. So first, let's talk about life insurance. The benefit of life insurance is it gives you financial protection for your dependents. So if something happens to you, the benefit goes to your dependents. And so it protects them from creditors. There's certain tax benefits, and it's also a way that you can save. So do you need life insurance? Well, consider if you have dependents and they count on your financial support, or if you have debts, particularly a home mortgage. If you do have dependents, they depend on you, and you've got a mortgage, then it's probably pretty likely that you need life insurance. But if you don't have any dependents, or if you're not even 19, you probably don't need life insurance. So if you do need life insurance, the next question then is, how much do you need? And so there are a few ways that we can figure out how much life insurance a person needs. First is what's called a multiple of earnings method. Very simple. You just take your annual earnings and you multiply it by some arbitrary number. Another way is a needs analysis method. This is going to be a little bit more detailed, where you estimate what your needs are, what your dependents' needs would be, and then you examine the available resources to cover those needs. So step one is to assess your family's total economic needs. So what income would they need to maintain their current or some adequate lifestyle? What extra expenses would they incur if you're no longer with us? Are there any special needs that your dependents have? How much would it cost to liquidate all of your debts? And then in step two, you would determine what financial resources will be available after your death, because those resources could be used first to cover those needs that you've identified in step one. So what savings and investments do you have? What income would your dependents get from your Social Security? Are there any other life insurance policies that you already have, or just any other resources? So when you subtract those needs from those financial resources, that tells you what you're short in terms of covering your family's needs, and that's what you would cover with life insurance. So when you're assessing your family's total economic needs, remember we mentioned how much income would they need to maintain a particular lifestyle? What extra expenses would they have? Are there some special needs? And what about debt? And then when we're thinking about step two with the financial resources, some possibilities are savings accounts, investment accounts, Social Security, pension plans, retirement plans, other life insurance, the income of your family that would continue after you're gone, and any real estate or other asset holdings that you have. So you subtract the needs from the resources, and that's how much life insurance that would be needed to provide your family with that certain standard of living that you've identified. So now, when we've identified how much insurance we need, what type of policy? First, there's a term life insurance policy that gives a specified amount of insurance protection for a set period. And so the benefit on that policy is paid if the person who's insured dies during that set period. And so it's basically the simplest type of insurance policy. So there are different types of that term insurance, and those include straight term, where the coverage remains the same even though premiums could increase; decreasing term, where the premiums remain the same but the coverage decreases. And so some important features in term insurance: is the policy renewable? without having to go through some sort of medical questionnaire or medical exam? Is it convertible to what's called a whole life policy? Again, without that medical questionnaire or physical exam. So here's some examples of premiums for different policies. So as you can see, depending on the age and the gender and the term of the policy, the premium amount will change. So as the term increases, the premium increases. Males are more expensive to insure than females, and as we get older, the premium increases. And then here's for a non-smoker. So big difference between smoker rates and non-smoker rates. So the advantages of term insurance: it's an economical way to purchase large amounts of life insurance. So typically for young families, it's economical because you typically don't have, the younger you are, the cheaper it is, and you don't have many medical problems. Disadvantages is as you get older, the premiums get more expensive and you don't build a cash value. With whole life insurance, it's a little bit different from term insurance, so let's take a break and come back and talk about that next.